Hi everybody. Hello. Are you guys able to hear me? If you can hear me, can you type um good afternoon, okay? GA in the chat so I know that this webinar, everything is great. Oh, I think all right, that's good. I see quite a number of you guys are here. Wow, really happy to see so many of you guys here. I know now it's a lunchtime, you're probably watching this hopefully not while you're working, okay? Hopefully you are having your lunch and also we wanted to organize this session because a lot of you guys have been telling us, "Hey, Longbridge, like do you have anything you can let us learn more about what are the product offerings that we have." And today I have a very, very special guest that I've invited from CSOP. Later, I'll do a proper introduction of him. And we got him here today because a lot of people have been asking us about REITs, has been asking us about dividends, and we thought now is a good time with the interest rate, holding steady. And, we really wanted you guys to learn more about what's available in the market and also on Longbridge as well. Okay, so now, basically, just a quick introduction. My name is Rachel, and I'm the moderator of today. And later, I know that you guys have probably some questions for Bruce later. You can also ask in the chat, and we can have a Q&A session at the end so that we can also answer your questions properly. Okay, now, just a quick disclaimer, Longbridge, uh, we are holding a CMS license and we are also dealing with securities and a lot of investments as well. So this session is really to give you guys some information and education as well. So if you have any questions, please do not hesitate to reach out for your financial professional advisors for your own portfolios. Okay, now to the very exciting part, today I've invited Bruce Zhang, and Bruce is actually the head of fixed income at CSOP Asset Management. He is also responsible for the bonds, the REITs, and also billions of fixed income strategies across multiple sectors. And Bruce is also very, very experienced. He has a CFA as well. So very, very happy to have him here today. So let's give him a warm welcome. Can you guys type Bruce in the chat and let's have him on the screen and we can get started with a session with Bruce. Hi, Bruce.
Hi, Rachel. Wow, you're highly interactive. Yeah, with your
Very,
with
very.
your yeah, and it's quite impressive. Yeah, I saw it, now it's more than 60 people attending the session, and numbers still rising. Wow. And thanks, yeah, everybody here spending your lunchtime and maybe watching our presentation instead of watching the World Cup. Yeah. So, to let me share the screen now. So, perhaps with the ongoing, let's say, the geopolitical uncertainty and also the AI boom, and we can see that now the US inflation and also the interest rate are quite sticky. But comparatively, within the nation of Singapore, the interest rate remains relatively low. So leaving, let's say, the SGD bank deposits and also the SGD T-bills at a relatively less compelling investment than before. So from this perspective, we can examine exactly where the Singapore and also the S-REITs are positioned at the current environment, as well as why the large and mid-cap REITs in Singapore will help investor, particularly the Longbridge investors, fight against the inflation with their decent yield and also cushion the investors' portfolio on the back of the current volatile market. So at the very beginning, let's try to address the soul question: why investing in the S-REITs and why right now? So first of all, we are still seeing a highly supportive yield environment. We also discussed this with Rachel before this call in Singapore, because the local interest rates, the risk-free rates, have dropped considerably from the peaks seen from a few years ago. And as the S-REITs existing cost of debt is higher than the prevailing market rates, it means that their upcoming debt refinancing will deliver the cost savings which can directly boost the DPU distributions. And additionally, the cheaper financing has also led to a rise in the acquisitions, as well as the so-called the AEI, the asset enhancement initiatives, which could fuel some future growth. And secondly, the S-REITs they offer some refuge in the volatile markets because financial markets have been exceptionally volatile ever since the start of this Middle East conflict in end of February, and also exaggerated by the AI-related trades up and down till now. So for investors who are seeking for some relief and seeking for some exposures to the resilient assets, the S-REITs are still highly appealing with their moderate correlations with both stocks and also bonds. And thirdly, the S-REITs act as an inflation hedge. I think everybody are quite familiar with. With the inflation on the rise, S-REITs are uniquely positioned to renew the rents at higher rates thanks to their negotiation power, which can in turn drive the positive rental reversions that can directly impact their earnings and also DPUs. And in terms of the fourth point, the investors could get some structural resilience because the S-REITs offer some peace of mind via their diversification across a wide range of the subsectors, such as retail, data center, as well as the, let's say, the grade A office buildings. Together with the geopolitical exposures, because S-REITs not necessarily invest in the Singapore projects. So from this perspective, together with the S-REITs relatively long lease profiles, it provides some additional stability. And the fifth point is not still not the but this the last point, the tax benefits, which is also a major advantage to the particularly for the individual investors. So looking at the immediate horizon, the next batch of the EQDP is also expected to be appointed. So this can also help more institutional investors deploying the capital and drive the inflows into the S-REITs. But of course, every investment, they also carry some risks. Given the current, let's say, the geopolitical uncertainties, macro growth uncertainties, together with the inflation risks, these kind of risks are still in our minds. For example, in most recent time, the U.S.-Iran conflict eased a bit, but there's still some uncertainties about the implementation of the reopening of the Hormuz Strait. Despite this, S-REITs are relatively insulated relative to other REIT markets and sectors because Singapore on a relative basis, it's a net exporter instead of a net importer. And besides that, while investors are concerned on the higher inflation and also the potential high for longer interest rate, uh, as uh, as the as long as the interest rate, whether this US or the Singapore, they are way lower than from their peers peaks in late 2024. Then S-REITs have broadly then S-REITs can still report relatively lower refinancing cost savings versus their previous debt cost, which can boost their distributions. So taking a closer look at the data to make sure to make sure we are less impacted by the war, we can see that over the long term, the S-REITs, as shown on the left-hand side, as proxied by our ETFs index, the iEdge S-REIT Leaders Index, it has a low correlation to the oil prices, which means over the long-term horizon, whether oil price will go up and down, there has no direct evidence it will impact the S-REIT's performance. So this could give investors some reassurance. And separately, as shown in the middle, despite the rising energy prices, together with the rising inflation expectations, which keep the U.S. SOFR rate sticky, the Singapore the SORA rate has stayed relatively low. But since the majority of the debt financing for the S-REITs are still in Sing dollar, so this is quite a positive signal. So this clearly exemplifies the divergence between the Singapore and the US REITs. And also, we have to notify that, of course, the inflation in Singapore they has been bottoming out in the in the right chart. We still need to watch these inflation change very closely within the nation. And moving to the domestic economy, I have to say it's still quite positive because multiple macro data points they reinforce that the Singapore economy remains quite resilient against the geopolitical headwinds. For example, the Q1 GDP grew by 6% is quite impressive, also somehow driven by the AI boom. And unemployment rate has been also relatively low, just around 2%. And in particular, the Nordics, the non-oil domestic exports, they has been very robust. They're growing nearly 40% year over year in May. And to echo this, the PMI, they also has been in an expansionary territory this year. So all of this, all else equal, they still provide a solid fundamentals for the S-REITs potential upside. And looking forward, of course, now the market now is pricing is pricing in a full so-called full Fed rate hike, perhaps by year end. But as we mentioned, the Singapore cost pressures are largely contained. For example, the Singapore's core CPI appears to be bottoming as compared to the 2022 levels, which used to be as high as 5%. And also the interest rate, we still see a large gap between the US and Singapore. So even the Fed starts, or let's say disrupted the current cut cycle and start to hike sometime, maybe later this year, the refinancing costs are saving for S-REITs may continue for a while before it finally went higher again. And in fact, the latest quarterly update, they also confirm this trend. Is usually you look at the second column, the most S-REITs they're getting a flat to lower borrowing cost ahead instead of higher borrowing cost. And this drop in the financing costs has also rewritten the M&A economics uh, because the deal activities has surged with the total real estate investment sales rising at 10% QoQ and over 100% year over year to Sing dollar 15 billion in the 1Q 2026 alone. And now investor might be thinking, sure, the borrowing costs are coming down, but on the REITs also exposed to the rising utility and also the rising energy costs. Yes, it can be, but the reality is that many REITs have also in place hedges and also the pass-through structures that insulate their portfolio from the rising utility costs. For example, for the CSCT, CapitaLand, is fully hedged for the remainder of this year. This also gives investors some reassurance that the costs are being well managed. And moving to the revenue front, rents are how REITs could make money and finally distribute cash flows to everybody. And despite all the market noise aforementioned, the rental reversions have been are still resilient with the, let's say, the industrial and the Grade A office rates, their rental growth outperforming in the first quarter this year on the back of this industrial expansion and also the tight CBD office supply. So all else equal, if you still see a positive, let's say high single digit positive rental reversion, then you should expect relatively decent performance of the S-REIT for the rest of the year. And at the same time, the S-REIT, the debt to total assets, the gearing, still remains stable, just way below this MAS revised the regulatory limit 45% and also the 50% respectively. This leaves more room for the REITs to conduct more value add business activities. And from the content we have covered so far, the S-REITs have proven that they still have some operational resilience. But what about the valuations? And here is the answer. Despite the S-REITs' healthy fundamental recovery, they continue to trade at a highly attractive price to book valuations of around zero point 0.9 multiple, which is still below the one watershed. And historically, based on our on sell side and our own research, when the S-REITs were traded at around zero point 0.8 to zero point 0.9 multiple range, we typically saw the support and further rebound in the next 12 months period. And to echo this, for particularly for those yield hungry investors, which is who is searching for the alternatives, now that the Singapore T-bills are less exciting, the S-REIT yield spread versus the Singapore 10-year government yield is a lot wider or a lot attractive than its historical average. And also, according to a JP Morgan survey, the so-called right yield spread, which many investors expect, it's around let's say 150 bips to 300 bips range. In other words, the current nearly 390 bips yield spread is already quite attractive. So as a result, the likelihood of the yield spread normalizing and also the narrowing down to the normal range and thereafter translating into a capital gain is relatively higher. And further, as you can see in this chart, the Singapore's 3.9% yield spread, they stand out as compared to the global REIT market, making it one of the most compelling income plays today. So which means S-REITs is not only attractive as compared to themselves, but also attractive versus their peers. And additionally, because S-REITs must pay out at least 90% of the taxable income each year to enjoy the tax transparency, the S-REITs investor can enjoy more attractive dividend yield for now. So from a sector distribution perspective, Singapore, as compared to other countries, is one of the Asia's largest and also the most diversified REIT market. And also with a Singapore core and also scoot towards the industrial and data centers. So this provide Singapore REITs more resilience. So I will elaborate this sector by sector. So starting from the cyclical office sector, even there are still some uncertainties about the macro recovery across the globe. The office sector is actually defined by the tight supply, which means over the past few quarters, the office vacancy rates have been declining across the nation. And this low vacancy rates, as well as known as the high occupancy rates, have led to the rents growing. That the implication here is that even the demand is relatively moderate, as long as the Grade A office supply is limited, then their rents are still expected to grow in the next couple of years. And in the meantime, the industrial subsector is definitely riding on the powerful structural tailwinds from these industrial expansion and also this global AI boom. And so far, the macro data have showed that the industrial production, Nordics and PMI have all consistently trending in expansionary territory this year. And this manufacturing momentum is largely driven by the rising AI-related capital expenditure. And to support, let's say, the local semiconductor supply chains, the third-party logistics, as well as the engineering firms, have been securing more logistics space. And also simultaneously, the sorry, I should keep this page. The data center demand has been ramping up, accelerating the enterprise and agent AI adoption is creating a massive AI workloads. And coupled with the rapid cloud expansion and the rise of new clouds, which offer the GPU as a service, this has driven a greater demand for data centers, and the industrial scale data centers make up the essential backbone for these advanced tech flows. So these are in simple, the rising demand has directly translated to the rising industrial and data center rents. Because when we talk about the AI boom, we talk about the competition of the calculation power. But to ensure this strong calculation power, they need to rent more. They need to rent more data centers. That's why S-REITs can also link to this current AI boom in AI investment themes. And moving to the retail subsector, the retail sales has been resilient this year and also accelerated in April, supported by the strong labor market and as evidenced by the relatively low unemployment rate that we mentioned earlier. And with the decent retail sales data in recent times, the prime retail rents have also climbed on both quarter-on-quarter and also year-over-year basis. But of course, we also need to be a bit cautious because if you look at this beautiful chart made by our analyst on the right-hand side, the supermarket sales have grown but the food and alcohol sales have been on a continued decline. This points to some early signs of the consumer prudence as shoppers increasingly prioritize the essential goods and services over the discretionary spending, and also the opening of the RTS between the JB and Singapore may also impact the let's say the spending in the suburban malls in Singapore. But at the current juncture, thanks to this AI boom, this will in turn boost some consumption in the Orchard malls. So we may perhaps see a K-shaped recovery in the future. These are not only in Singapore, but maybe across the nation, across the globe. And finally, for the sector outlook, we still have the hotel sector. And based on the data from the Singapore Tourism Board, the visitor arrivals have trended downwards since the conflict began. This is not surprising because the higher airfares and then the flights are rerouting because we need to avoid the Middle East. They temporarily dampen the long-haul travel demand. But luckily, the short-haul travel should also remain resilient because someone may, instead of moving to Europe, flying to Europe, they just might maybe keep their travel spending within the APAC. So this can also cushion some of these overall impacts. And now that we have established why S-REIT are still primed for a comeback, the next logical question is how can capture that this trend and also effectively managing the risks. So this brings us to our solution to use this SGX, iEdge, S-REIT Leaders Index. So in addition to picking the individual REITs, investing with a benchmark index gives investor instant diversification across the multiple REITs, the sectors, as well as the geographical exposures. So diving deeper into the key metrics of the index, it delivers a highly attractive dividend yield. For now, it's nearly 6%, which exceeds that of the Straits Times Index or the Singapore 10-year bond yield, Singapore inflation, as well as the SGD deposit rate, respectively. And moreover, if you look at the chart on the right-hand side, as compared to the major REITs and equity index globally, the iEdge S-REIT Leaders Index is actually one of the most compelling risk-adjusted dividend plays because their volatility is just low double digit or sometimes just high single digits, but their dividend yield is almost the highest. So they have both the attractive yield together with the lower volatility, translating into the high return risk ratio. And again, the leading, as mentioned, the leading position of the S-REIT yield is also boosted by the IRA's requirement of at least 90% of the taxable income to be distributed to the investors. And of course, investors might be wondering that what is so special about this iEdge S-REIT Leaders Index. And again, the index launched by the SGX is customized to represent this so-called cream of the crop within the whole S-REIT universe. And this is achieved using a liquidity adjusted free float market cap weighting methodology. So to simplify the jargon, what this essentially means that the index just filters for the largest and most liquid REITs listed on the Singapore exchange, so that we are investing in the top leaders REITs within the space. So thanks to this screening, this gives a portfolio of 23 REITs as end of May, which is well diversified across sectors like industrial, retail, office, and data centers, as well as across the multiple countries by underlying revenue breakdown, such as the Australia, Hong Kong, and UK, Japan, and United States. So it means that even investors' underlying portfolio, all Singapore REITs, they can still have the underlying project across the APAC or even across the globe, but your withholding tax are still zero. And further, with a 10% cap for each securities, these can ensure the index produces a highly diversified portfolio that is not dominated by any single entity. So why is filtering for the large or mid-cap S-REIT leaders so important? And if we start from the right-hand side first, the historical data have shown that large REITs or the REITs are ranking the first quartile by their market cap. They do offer a better risk return profile, and this outperformance is due to the a virtuous cycle of the scale. Then if you look at the chart on the left-hand side, with a large market cap, this facilitates greater operational efficiency, which lower the cost of capital, supporting more accretive acquisitions that offer higher payout, which then in turn attract more liquidity, which can reinforce this positive spiral. And furthermore, the larger S-REITs tends to have experienced managers like the government-linked sponsors like the Temasek or the Capital Land. And these sponsors could ensure that the REIT portfolios are better managed. And additionally, they offer the REITs better sponsor pipelines, greater access to better and more accretive deals that enhance the profitability and ultimately raise the distribution for the REITs. And to echo this, the table, the top 10 holdings, index holdings, as early as at early June, you can see that the top 10 entities make up the 76% of the total weight, offering the exposure to the titans of the REIT sector. And most of them are anchored by the government-linked sponsors and their largest as their largest unit holders and the sponsors. So to illustrate why investing in a basket of REITs, in addition to the single REITs, proxied by our ETF's benchmark, um, which can act as an efficient complement to the individual REITs selection. This chart demonstrates that how the benchmark's volatility is way lower as compared to the individual underlying S-REITs due to the power of the diversification. Because although they are all S-REITs, their sectors are different, their geographical exposures are also quite different. And after covering the power of using a benchmark, I'll now share more about the ETF vehicle that investors can access on SGX and of course also available on the Longbridge platform. And the fund is the name is the CSOP iEdge S-REIT Leaders Index ETF. The ticker code is SRT for Sing dollar and SRU for US dollar. I have checked with Rachel, and both can be found on the Longbridge platform. And as of late June, our fund AUM has already grown to a sizable size at Sing dollar 130 million, and we pay out distributions semi-annually in February and or August, giving all these yield-hungry investors. And now we are still discussing the details of the upcoming ex-dividend date. But what I can say that the ex-dividend date is more or less in the mid July, and the payment of the dividend for this year will highly likely in the late August. And now the indicative yield is still around 6% annualized. And aside from the diversification, some of the investors might be thinking that since the S-REIT is attractive, why not I just and the basket trading makes sense. Why not I just DIY and buy the respective REITs by myself? I would say it's possible, but it all comes down to tracking cost and also the liquidity efficiencies. Because given the large scale, we as a ETF manager, we have a dedicated trading desk executing the trades with the greater efficiency and enabling us to closely track the benchmark index and also ensuring the investors are getting what they paid for. It also ensures lower trading costs than if the individual investors try to execute the trades themselves. So that's why, as seen in the chart, our ETF maintain a very tight tracking difference and also even slightly outperform our gross of fees versus the benchmark across the various time horizons. And since the SRT, the ETF listing, the dividend yield has been really quite attractive and also stable, maintaining a historical average yield of 5.98%. And to reiterate, while the Singapore 10-year risk-free rate government bond yield sits at just 2.1% level, they indicate of the dividend yield of SRT, the hands investor and very exciting nearly 6% indicated dividend yield for now. And of course, it's no secret that on Singapore exchange, there are other REIT ETFs, or we can't mention their name, but we can give them a number, but always a slightly different index methodologies. And the key differentiator here is that our ETF has the highest indicative dividend yield, but still with a relatively fair PB valuation for now. And further, the underlying REITs within our ETF portfolio, majority of them are actively traded, which also give us the ETF the liquidity to ensure the better tracking of the benchmark index. And in this slide, to echo my point in the previous slides, we can see that the trading costs are a lot cheaper if investors using this SRT ETF, given the much tighter beta spread as compared to an investor directly investing in a basket of the underlying REIT. And additionally, instead of paying the high entry cost of over Sing dollar 3,000 to invest in a minimum lot of each of the underlying S-REITs, investors now only have to pay around, let's say, 75 cents per share to start from one share of the SRT ETF investing on the exchange. So it is quite friendly to the individual investors. And separately, because the underlying REITs are large and liquid, and we have a dedicated trading desk, we are confident to handle the primary flows, let's say up to 30 million in and out daily. So it's simply based on the historical experience, and the actual potential is even higher than that level. So to every individual investor, you never need to worry about the liquidity issue, even at some time you would like to redeem your shares or sell your shares on exchange. So all while still being able to outperform in tracking our benchmark as compared to our peers, as seen in this chart, or in other words, we outperform more versus our index, but still keep tight tracking versus our peers. So to summarize, there are three key takeaways for this presentation before we enter in the Q&A. First, why S-REITs? From a fundamental perspective, S-REIT outlook has stayed resilient with a decent first quarter update featuring the lower borrowing cost and strong rental reversions. And, and the low borrowing cost have also resulted in the positive asset yield spread relatively to the cost of capital and fueling the S-REIT's growth via the M&A, which I have seen year to date. And why now? From a valuation perspective, the S-REITs are attractive with a PB ratio at around 0.9 multiple and a compelling dividend yield nearly 6%, which gives a very attractive spread of 3.9% versus Singapore 10-year yield. And lastly, why invest in the CSOP S-REIT ETF, SRT? Our ETF benchmark is skewed towards the large and mid-cap S-REITs, which have historically outperformed their smaller peers. And additionally, SRT has consistently been outperforming in terms of the tracking error and the relative performance since its inception. And we are managing this ETF to make sure it follows the index performance closely and also ensure the investor could get these shares to get in an efficient way. And with that, I open the door to questions. Also, hand over back to Rachel to see if you would like to add more to help investor to buy or trade this ETF on your platform.
Yeah, thank you so much, Bruce. I think that was a really great insight of the S-REITs. And I think something very interesting that you really pointed out before we go into the Q&A is that, it's really very attractive. I think at 6% dividend indicated yield, it's really much more attractive than, like T-bills or government bonds. And for all of our Singaporean investors, it's really something that you can have a look at to add to your portfolio. And also, yeah, now we can probably open up to the Q&A segment. And for those of you who have questions, you can post it in the chat. Don't be shy. It's very rare that we have Bruce together with us and also the CSOP team here as well. So really happy to answer any questions. Okay,
Yeah.
we have our first question. I'll stop share Bruce's screen. All right,
Yeah.
Melvin is asking the
Mm.
potential interest rate increase, how will it affect the REIT and ETF performance? Bruce.
Yeah, I think that's a quite a great question because all else equal, I would say the higher the interest rate, perhaps potentially the lower the rate performance or even the ETF performance. But I would say at the current juncture, some of these potential, let's say, the pause of the cut or the hiking, or even the expectation of the higher interest rate, they are somehow priced in the market. I think that's one point. And secondly, as I mentioned in my presentation before, or even the U.S. Fed, they kickstart the rate hike this year as compared to their peak of the in terms of their debt cost. Um, even a one or two times hike, they may not stop the cheaper rolling of their existing costs because typically the S-REITs their borrowing their borrowing tenor is spans from 3 to 5 years, which means the last round they're rolling at a very high interest rate. But now but now despite the bottoming out of the interest rate, their newly rolled interest rate are still way lower than their previous peak. So from this perspective, we should continue to see some lower interest rate or lower debt cost for the S-REITs. So So from if we combine these factors, so then the potential interest rate increase may not necessarily mean that the S-REIT's performance will be bad, which means that the performance can be still resilient if they manage their interest rate maturity well.
Right. Thanks for the answer. And I think Amit has a question. Can you comment on the weakness of the US data centers? I think just now Bruce did mention about some of the data centers being in Singapore as well, thanks to the AI boom. And also for commercial space, the impact exposed to REITs like Mainclar and the interest increasing rates in Japan. I think that's in US and Japan's context lah. I think
Yeah,
not of
yeah,
the
I can have a very top down or a very simple answer on this. First of all, just as Rachel said, our REITs, data center REITs, the exposure is mainly in Singapore and in APAC, not in the US. So the weakness of the US data centers may not have a direct impact of this ETF. And secondly, when we talk about this data center expansion, I think I want to talk about the big picture. The the US edge in terms of this AI competition is actually their high-end technology or their efficiency. But the US, they are facing some labor shortage. They're also facing some electricity power generation problem. That's, I think, is can impact their long-term competitiveness. But comparatively, within the APAC, including China, their competitiveness is mainly stems from their, let's say, strong power generation and electricity utilities. So this provide a chance for the APAC data centers to catch up with the US data centers. That's my answer for this question.
right. And also we have another question in the Q&A box. Besides dividend returns, has there been capital gains or losses for the S-REIT?
I saw this question. The 6% dividend yield is before cost. Could you please elaborate on what are the costs that investors need to bear using the Longbridge platform? I won't comment on the Longbridge part, but from the issuer part, in fact, these are 6% dividend yield. When we pay this out, we already consider the cost, which means every day when you see the SRT NAV, when you see the SRT price, it's already after the annualized 60 bips TER. So which means you don't have any other costs. And also maybe I can share back my screen, right?
Go ahead.
It's easy to elaborate this. Yeah. Yeah, if you look at the performance here, uh, despite that we have a TER at 60 bips per annum, this TER first of all is capped at the 60 bips, which means regardless of the size of the ETF, the TER will be capped at like this. And since inception, we also have try to achieve a very strong performance. Um, because even after the 60 bips TR, we're just slightly behind the benchmark. So from this perspective, we already try to save a lot, both from the tracking perspective and also from the trading perspective, as I mentioned before, because using the SRT ETF, your beta spread on exchange already much lower than you directly investing in the underlying basket of the REITs. And other than that, I don't see any cost from the issuer or from the ETF perspective. Maybe Rachel, you can mention that any cost from your platform.
Yeah, for Raymond's question, costing wise, well, for us, we are actually commission free. So there isn't any cost on later I can show you guys on the Longbridge platform as well. Or maybe I can show it now. I think it's a good time to share as well.
Mm,
For
yeah,
those of you who have our Longbridge app, let me open
with
it up.
Iran, oh, you are sharing this, sorry.
Yeah, I can
Oh
share
yeah,
on the Longbridge.
I'm still reading the questions. Yeah, you
Oh,
please
okay.
share
No
first. It's
worries.
okay.
Yeah,
Yeah.
I can just do the demo first.
Yeah.
Okay, so for those of you who have a Longbridge platform, so how you can actually search for the S-REIT or the SRT, you can simply just type S-REIT or you can type SRT. And then it comes up CSOP IH S-REIT ETFS. So you can click on that and you can go ahead to have a look. You can go and buy. Okay, for those of you who don't have, you can't sell yet. But you can, here's the place where you can click on it. Um, however number of quantities that you want, and then you can click submit. So it's the same as how you would actually buy or sell any stock on the Longbridge platform. So as long as you type in S-REIT or SRT, you can go and see what is the current prices and also what's the quantity that you want. Yeah. So
Mm,
yeah. So
thanks. Yeah, I'll continue with the
yeah, with the
question.
questions. Yeah, I think
Yeah,
that is the question. Yeah.
yeah. With the Iran war ending, will Sora increase with less fund coming into Singapore, safe haven? Good question. I think if let's suppose the Iran war ends forever, um, I would say the Sora maybe getting lower because at least from a nominal inflation shock perspective, we have less uncertainties from the Holmes Street. So from this perspective, I don't think this can increase the SORA. And also, will the fund coming into Singapore a safe haven, less funds coming? I would say after this war, I would say this, I think more investors had to have a different thinking because before that, if you look at the property market in Dubai, in Riyadh, they're crazy. They're going crazy. But after this war, I think that now investors they need to rethink about this because even the Iran war ends doesn't mean that there won't be another war in the future. So now investors, that's why investors after the war began, we see the flows. They moving back to Hong Kong and as well as Singapore. So the answer is that SORA may not increase, but the flow may continue to diversify to APAC region.
Yeah, definitely. And you know, you mentioned about Dubai. It's very, very interesting. So I have friends who have properties in Dubai and they were actually during this period they were actually looking to offload and come back to Singapore properties as well. So it's a pretty much an impact for us, but in a good way for our Singapore properties, right? Okay, maybe one more
Another one? Yeah, I
from
saw
Alvin.
another one.
Yeah.
Yeah. Yeah, the dividend yield 6% based on today's market price, or that's down around 6% yield. In fact, when we decide our dividend, we just strictly follow the index, which means let's say if over the past let's say half year, let's say in July when we review these first 6 months, if our portfolio yield is higher than the index yield, benchmark yield, we will pay our portfolio yield. But if our portfolio yield is lower than the benchmark yield, then we'll pay the benchmark yield. So which means we will pay at least pay the benchmark yield. So at now, as long as the index yield is remains at around 6%, so it's highly likely that during the before the dividend date, our announced dividend yield will be around 6%.
Okay, hope that answers your questions. I mean, I don't see any questions coming in. Yeah, before we end off, Bruce,
Yeah,
any last
yeah.
words or any last
Yeah, I do have some. Yeah, I do have some. I think because market now are still volatile. For example, now the consensus is that the geopolitical tension it's eased, but there's still some uncertainties. And also, of course, market are chasing this AI momentum higher and higher. So when investors, if you would like to buy this SRT. I still recommend that you buy at the dip. Let's say when if you see today you see a large correction, then you buy more. And if you see a small correction, you just buy small amount. But if you see a large rebound and rally, you just maybe hold to till the next correction. Then you can benefit from this the current seesaw session or the market volatility, at least for the next for the upcoming 3 to 6 months period. I see more questions. If we
more
still have time,
questions?
I can
Yes, we do.
answer them.
Yeah, maybe
Would you read?
Fantastic.
reduce the capital for the dividend, I will highlight that every time, because our benchmark it's a total return benchmark, and every time when we receive the dividend from our underlying REITs, we will reinvest to make sure we track the total return benchmark. And once the ex dividend comes, then we will we'll sell our stocks to raise the fund. So the concept is not like a reduced capital for the dividend, but the concept that every time when we receive the dividend, we reinvest them immediately to make sure our performance always tracked the total return index. And once the payment date comes, then we will uh, sell them to make sure that you can enjoy the same dividend as our benchmark. So it's not simply like a capital reduce the dividend from the capital. And also, how to check the dividend yield percentage? You can uh, if you cannot, I'm not sure if you can see it on the Longbridge platform, but if you can't see that, you can directly go to our company's website. It includes the full history our dividend payment, and it's available to all the public.
Yeah, I
Yeah,
just sent it in the chat itself. If you go to CSOP's website directly and you look for specifically S-REITs, you can see
yeah,
how's the performance, how is the stock has been doing. Yeah,
yeah.
yeah. Ralph also said
It's very timely yeah link from our sales, Rafael. And also how SRT compares to with Sierra. I would say again, it's not. I won't say that ours is always the best. It's not a black or white argument, because Sierra they're more focused on the smart beta approach, which means they in the history it seems they are more defensive during the market downturn, let's say the year 2021, 2022, 2023. But on the in the when the markets start to rebound, it seems our ETF tends to perform well, because our ETF use a very transparent liquidity and cap weighted approach, which means we are quite sensitive to market change. Both sides, when market go down, we also go down, precisely mimic the market performance. But when market rebounded, we are also rebounded very quickly, because we just use the large and mid cap, the most liquid names in our portfolio. And our portfolio is published on a daily basis. Everybody can access. So we are confident we have a cost edge to help investors using our ETF instead of directly investing.
yeah, great. That answers PK's question. Yeah, so I think for those of you who wants to find out more about S-REITs, you can go to the website that Ralph has sent, and you can also ask for more information. Bruce, is there any contact that they can, if they do have questions about S-REITs?
It's
Uh,
here already, the Raphael, the
okay.
Mr.
Yeah,
Yeah.
you can also contact them from
Mm,
their website. You can send them
mm,
an email. I think that's on the top of the page as well. So hope that this session gives you guys a very, very good insight of what's available in Singapore REIT, S-REITs, and also Singapore's environment of there's a lot of products that you can actually look at from CSOP. And I want to share it with you guys as well. Oh, I think one more questions. I
mm.
think a lot of questions still coming in. Max is asking year to date compared to STI.
Good point. Good point. Yeah. I would say year to date, STI is still strong. Still strong. It's not surprising, because if on the back of the high for longer interest rate environment, STI, the underlying the mainly comprising of the banks, they're still benefiting from this high for longer environment. And also the Singapore banks, they are not only have the lending business, they also have a very strong wealth management business. It's also echo that why the flows there, the from Middle East, the wealth flows from the Middle East to the Singapore. But what I want to highlight here is that to buy STI is not a conflict to buy the SRT, because STI are representing the bank names, the defensive names, dividend, stable dividend, and the benefit from the high interest rate environment. But SRT, it's just different animal. their dividend source is not from these their lending business or the wealth business. Their dividends from their rental business. And if the interest rate at some time they can if we reach a turning point, because now we are still facing a K-shaped recovery now, then the SRT can still benefit from and at least can be a good complement to STI for this year. And in fact, I saw some questions that also in the Q&A part, not in the chat part. I'll see
Yeah.
whether there's some duplicated one or a
Yes, I
new one.
think the first one is
Is it
answered.
duplicated for the long bridge? I think there isn't much flow or outflow for SRT. I saw that.
Yeah, that's
Yeah.
answered
Is
already.
it normal? I think before this call is normal, but after this call, we should expect to see more inflows, right?
Yeah.
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 And what impact on S-REITs do you foresee if the U.S. market hit by the AI bubble or the impending $1 trillion AI IPOs? I think suppose nobody would like this to happen, right? But suppose let's say the AI bubble finally burst at maybe 3 years later, for example. I would say every risk asset initial response will go down initially, no surprise initially. But REITs, they have a lot of potential. For example, the SRE portfolio, only 15% is data center, 85% are still the retail, industrial, and also these let's say healthcare and also hotel REITs. And even for these 15% data center, and together with the other 25% industrial REITs, because of these halo features, the heavy asset, low obsolete features, they can anyway change their usage if the AI bubble turns into burst. So as compared to the current technology names, software, hardware names, if let's say the AI bubble finally proved to be wrong, then we the existing industrial REITs and data center REITs, they can change their style very quickly to provide more defensive features. That's why when the AI boom comes this year, they are also mentioned these about the HALO Halo features mentioned by the Goldman Sachs. That's why the data centers are always in a good position, and that's also provides some cushions for the S-REITs if that really happens in the future. Yeah.
Right. That's great. One more question from Andrew. Proportion paid out of capital is increasing. Any
Yeah.
comment on that? I think he did supplement with.
It's not. It's no. Any. There's no. It's not natural or what I want to say is that whether the capital the paid out of capital is increasing or decreasing is quite natural because as I mentioned we use a total return approach, which
Mhm.
means it depends on how the reinvestment and happened and how the underlying REITs performed after they pay their own dividend. So, but once again, what we can ensure that for all the every cent we received from our underlying REITs, we 100% pay out of the to pay back to the investors. And if the dividend yield is lower than the index yield, we just make sure that our ETF dividend yield is not lower than the index yield. Yeah. And I'm referring to the 0.022 dividend. Not sure what that mean. This one, the dollar dividend in dollar per share may vary from time to time because let's suppose we still define 6% as our dividend yield in the upcoming payment. Then it also depends on the price of that date so that you will know that the dollar amount at that time. So it's still unknown, but it will coming very, very soon. It will be coming in early July. So I cannot tell you what is the exact amount for now. And what's the institutional interest? I think that's a very good question because when we first launched that, the institutions used to participate in this ILP of the ETF. And for now, since we'll grow our AUMs over Sing dollar 100 million, we also start to attract more insti flows. I can't mention the name, but I can say that some local well-known asset managers also use these ETF to conduct their asset allocations.
Nice. I think one more question from the main chat, from N. If you pay index yield from when your fund's dividends yield is lower, it means that you pay out from capital. Am I correct?
Not necessarily. As I mentioned, it's a complicated approach because it depends on the how the reinvestment, the timing of the reinvestment as well. So it's not we can't simply say that our fund yield is lower. It means that we paid out of capital. Yeah, it depends on the market change, depends on the reinvestment timing. Yeah, so it's not a simple answer for this question.
Right. So if you guys do have still have any more questions, like I said, feel free to reach out to CSOP via the link that I have shared previously. And yeah, I want to thank Bruce as well for this really insightful session, and also all of you guys here for being so attentive and also to ask so many questions. I think that's the first time our attendance is also very, very high during a lunch hour session. So I hope you guys enjoyed today's session. And also, just to let you guys know that next month we also have another session with Bruce as well on the 22nd of July. I will be sending you guys more information on that nearer to the date, and we'll be sharing a lot more than just Singapore, a bit more on the APAC region as well, and where's the next big opportunity. So looking forward to have you again, Bruce, and hope to see you guys all back again next month.
Bye bye.
Thanks, Bruce. Thanks, everyone. I'll see you guys. Enjoy your lunch. Bye bye, everybody.